Hello everyone, and welcome to the PV Technology Costing and Finance Models in Developing Environments webinar. This expert training series is supported by the International Solar Alliance, Clean Energy Solutions Centre, and the Carbon Trust. Today's webinar is going to focus on costing and finance models in developing environments and is an additional module to the 8 previously covered. Today's agenda looks as follows. We'll start with an introduction to the investment trends in solar PV technology, the costs at the various scales, including utility, community, and residential scales, traditional finance models, alternative and innovative new finance models, a few developing environment case studies, and then a few final remarks to close off. So, what is our learning objective? Today's objective is to provide an overview of the investment setting for solar PV projects specific to developing environments and highlight the finance mechanisms used to fund these projects. We want to develop an understanding of the cost and tariff structures associated with solar PV at the various utility, commercial, and residential scales. So, the investment trends in solar PV. Globally, we can see that investments in renewable energy has increased quite dramatically since 2004, and the portion of global renewable energy investment which has gone to solar PV investment has increased dramatically as well. And we can see that in the last few years there on the far right, solar PV has typically held close to half of the overall renewable energy investment. The decrease in solar PV investment as measured in US dollars between 2015 and 2016 can be attributed to two things. The first being a fall in the costs of solar PV, which means that you get more capacity installed for less investment. And the second reason is due to the fact that a few countries such as UK, Japan, and China began cutting the subsidies in 2016, which meant that a lot of the developers were pushing to get the projects finalized and commissioned by 2015, and then the dip thereafter is as a result of the change in the political landscape and the subsidy environment. Capacity, however, still reached a record high in 2016 of 65 gigawatts. So it's not to say that the capacity has come down, it's the investment as a result of these two factors that decreased between 2016 and 2015. An overview of the types of procurement mechanisms between the countries. We can see that since 2005, the increase in public investment in the form of loans and grants, which we'll look at later, auctions and feed-in tariffs or premiums has become the mainstreamed procurement mechanism around the world, with renewable energy certificates not increasing as dramatically as the other procurement mechanisms. So this is just to give an overview of how most countries procure their renewable energy across the world. So let's have a look at the costs associated with solar PV at the different scales. It's important to separate the costs to the developer and the costs to the consumers. So when we speak about developer costs, we are looking at the capital expenditure, the CapEx, and we're looking at the operating expenditure or the OpEx. So the CapEx is the upfront capital needed to get a project commissioned and includes the materials, the equipment, labor, cost of finance, and those sorts of things. Operational costs or OpEx are also labor involved in the operation and the maintenance, the maintenance costs, of course, taxes, insurance, rental, and these types of costs that go on throughout the lifespan of the project. And these are both borne by the developer. And on top of these costs, the developer needs a return on his investment in the form of a profit margin or an internal rate of return that they use to compensate them for the risk taken by developing the project. And this profit margin is calculated and is worked into the electricity tariffs that are then sold on to the consumers. So the cost to the consumers is just the electricity tariff, but the cost to developers are the CapEx and the OpEx costs. When looking at a solar PV project, we can see that there are broadly three main cost components: the solar module, the inverter, and the balance of the system. And the balance of the system is everything, all hardware that's not an inverter or a module, and it includes the cabling, the support structures, and these types of hardware, the installation costs, the labor, the transportation, logistics, and that sort of thing, as well as the soft costs such as finance costs, permitting, and system design. And we can see that historically, the modules have been the major cost components in 2009, accounting for more than half of the overall project cost, but have since declined rapidly in the years to date. So we can see that in the past few years, the recent cost reductions have come mainly from reduction in the solar module costs. However, going forward, it's expected that the cost reductions will come from reductions in the cost of the balance of system components, reduced costs of financing, reduced costs of the other hardware, and permitting costs, etc. Again, we can break down the costs at each of the various scales. And if we look at the year that we're in, or in the closest year to us, 2018, we can see at utility scales, the cost is lowest. So the cost per unit, in this case, cost per watt, is around just over $1 per watt installed, whereas at residential scale, it's $2.7 per watt. Commercial scale, 1.83. So there are higher costs per unit associated with residential and commercial scale due to the reduction in economies of scale. And we can see that the soft costs make up the majority of the residential and commercial cost breakdown, whereas this is not the case at the utility scale. That provided us with an insight into the CapEx costs associated with the solar PV projects at the various scales. However, to compare this technology with other types of energy technologies, we use what's called levelized cost of energy, which breaks down the cost per unit electricity provided from the project. And how this is done is it sums the amount of energy throughout the lifespan of the project, and it sums all of the costs throughout the lifespan of the project, from the CapEx and the OpEx, and it divides the total cost of the project by the total expected energy to be produced to yield a cost per unit energy for the project. And obviously the future costs are discounted at a defined discount rate, as well as the electricity generated in future also being discounted at a predetermined rate. So looking at the LCOE for the various scales, we can see once again, residential and commercial scale are costlier than the utility scale on a per unit basis. However, utility scale PV is seen as being cost competitive with conventional and fossil fuel technologies. In this diagram, the cost of capital assumed is 6% for the cost of debt, 10% for the cost of equity for the light yellow bars, and the orange colored bars assume an 8% cost of debt, 14% cost of equity. So we can see this would probably be in a developed environment because the cost of debt and cost of equity is relatively low here, which we might not be able to see in a developed or a developing environment rather. But we can see that the cost of debt is typically lower than the cost of equity, and residential per unit costs are notably higher than the other scales. The main factors affecting this levelized cost of electricity would be the load factor, how much electricity the project is able to produce relative to its installed capacity. So the higher the load factor, the lower the LCOE. The lower the load factor, the higher the LCOE. Because more energy produced throughout the project lifespan, it will reduce the cost per unit from that project. Another factor that affects the LCOE is the resource quality, which would be, in this case, the sunshine hours received, and this varies by location. The weighted average cost of capital, as we can see in the diagram, and the discount factor used in the LCOE are the main factors that affect the LCOE figure for the technology type. And we can see here, when comparing developing and developed environments, the developing environments in Asia, Central America, and Latin America are seeing very cost competitive solar PV projects, especially when compared to their developed country counterparts in North America and Europe. Africa, less so competitive, but still providing affordable and cost competitive power compared to conventional technologies. The range, you can see the range in Europe is significantly less than that in Asia and in Africa. And the varying LCOEs are due to the very different location, regulatory, and economic settings between these countries and between these environments. First, we're going to have a look at the traditional solar PV finance models. And we can see that the majority of the funding in 2015 and 2016 was derived from private sources, private financial intermediaries, and private sources. So this would be your infrastructure funds, your venture capitalists, project developers financing themselves, corporate actors, and other such private entities. The public finance intermediaries, which would be your development finance institutions and that sort of thing, they provided a much smaller chunk of the funding. And the instruments used have been dominated by debt and equity, with concessional loans and grants and other forms of funding coming or accounting for a much lower portion of the overall. And we can see the recipients of it. So this would be the developers, again, primarily private developers that are constructing and implementing these projects. And a very wide variety of where the finance is flowing, although East Asia and the Pacific, as well as the developed nations in Western Europe and the OECD, accounting for the vast majority of the finance flow. And again, we can see solar PV and wind are the predominant technology types that are receiving these funding. So when looking at the instruments used to finance these projects, there are broadly three different instruments: grants, equity, and debt. We can see here that the grant funding is typically high risk, so they can take on a lot of risk, and they are sourced from governments, angel investors, impact funds, and non-profit foundations, which is why they have a higher risk appetite. They're willing to take on additional risk to facilitate deployment of these emerging technologies or these pioneering projects. And in some cases, they don't expect any returns, which means that the cost of the capital from this instrument is very cheap for the developer, or it can be commercial, depending on the source. However, this is the most affordable cost of capital, but it is not always available, especially in developing environments where there might not be capacity for the government or government institutions to be lending to projects of considerable size. The next category, or the next instrument, being equity, typically a reasonable risk appetite. However, the cost of the capital from these sources is typically considered to be the highest, 15 to 25%, or at least over 25% if it's on a commercial basis. And these can come from a variety of providers, from venture capitalists or impact funds to private equity, institutional investors, and development finance institutions as well. Lastly, debt, which is seen as the most affordable commercial form of finance. It typically comes from your local or your international banks, again, also your development finance institutions, and varies between 16 to 24% in local currency and less in hard currency due to the fluctuations and the depreciation that might be seen in a local currency, which would make it more expensive for the developers in developing countries. And there's a variety of sources from there, depending on the capacity in the local environment and the appetite of the commercial banks. And these are the two main finance models that we see, typically at utility scale, but not necessarily at utility scale only. In the corporate finance model, the investors and the lenders provide finance against the sponsor or the developing company's balance sheet, against their assets, and they then use that funding to develop the solar PV project. And this differs from the project finance model, where the project company is a separate entity to the developer, and it's provided finance based on the expected cash flows from the project. So financiers and investors, they provide money to the project against projected future cash flows from the project. And that's the primary difference between these two. The corporate finance model is against the balance sheet of the developer, whereas the project finance model is against the projected cash flows from the project going forward. And there are numerous financial barriers to solar PV deployment in developing environments, mainly the long-term horizon associated with the projects, leading to long payback times, lack of capacity in developing environments for these high-risk long-term assets. Solar PV being a new and unfamiliar technology in some cases make acquiring finance a bit more difficult because there's no well-established risk profile. The banks or the lenders aren't familiar with the technology and they're not comfortable with the environment yet, as well as the big financiers not being interested in small scale projects that we typically see being implemented in these emerging environments. So international commercial banks, international investors are typically targeting the large scale projects where it's bankable. They have had projects that have been deployed there before and they know the environment. And these issues all lead to higher cost of capital for these developing environments and a lack of finance being provided to these types of projects. And again, we can see it's not just on the debt and equity sourcing side, it's also there's revenue risks associated with solar PV projects going in areas where they haven't previously been electrified. You don't know the customer's purchasing patterns, you don't know the demand profiles yet, which all create elements of risk for the project. There are technology risks, there are regulatory barriers as well, which limits how quickly and the integration of solar PV into the grid or into the setting, and can cause time delays and restrict the viability of the project as well, without political buy-in and without the available capacity on hand to administer and oversee these projects. Once again, the debt funding and debt finance is seen as the most affordable of the funding instruments, especially on a commercial basis. However, equity finance can be deployed much quicker than debt finance, because debt finance, especially from commercial banks or international banks, they require a lot of due diligence before the finance is released, whereas a developer who has equity, if there's time constraints, he can deploy that finance a lot quicker than the debt. Now, just looking at the procurement mechanisms which affect how much and the price of the electricity coming from these projects, we see broadly there's two different types. There's a price-based and a quantity-based procurement mechanism. So under the price-based mechanisms, this is where you find your feed-in tariffs and your feed-in premiums predominantly, where the quantity is not capped, but the price that's paid for the electricity is determined by the regulatory body. So developers then know they can develop whatever scale project they can afford to build, but it must be within a certain feed-in tariff cap. And so the price is known, but the quantity is up to the developers to determine. Whereas in a quantity-based procurement mechanism, such as an auction or a tender scheme, you see that they would cap the quantity. So they would say, we're capping it to 250 megawatts, just as an example of solar PV power, and the developers then bid against each other on the price and the economic performance measures to see who will actually get awarded the project in the end. So there, the price is not known, it's competitive, but the quantity is capped. So those were the traditional finance models and the procurement mechanisms. And now we're going to have a look at the alternative and the innovative finance models that we're seeing coming in at the moment. So a lot of the innovation is going on in the smaller scale area, especially looking at mini grids. So we can see here that mini grids are more expensive than a grid in an urban, highly densified and closely located to the existing grid environment. However, it's still cheaper than a solar home system, which has a fairly flat cost profile, doesn't vary much depending on the density, the location, or the size. But we can see here that extending the national grid out to areas of low density, far away from the national grid, and in small communities, it's exponentially more expensive to send the power out there using the national grid. And the mini grid offers the opportunity to electrify these environments where it's low density, it's fairly far from the national grid, and the economic strength is not that well known. And then going even further, when you go extremely isolated, very small scale and low density, then the off-grid and the pico solar becomes the preferred intervention measure. And when looking at mini grids, we can see that there are a variety of ownership and operation models that have been implemented to date. Now, the operator model does not determine or is not concerned with the technology that's used. So a hybrid operator model, as we can see here, is focused on the ownership and the operation of the project and is not the same as a hybrid mini grid, which could be solar or diesel. So the operator model has nothing to do with the technology type. It's to do with how it's owned and how it's operated. And we can see there's 4 broad types: the utility operator model, a private operator model, community-based operator model, and a hybrid operator model, which is a combination of the above. And as the names suggest, the utility operator model is typically run by a government-owned entity that sourced funding from national treasury or from grants at concessional rates and is then operated by this utility, whereas a private operator model uses private funding, although not exclusively private funding, and is operated by a private developer. Community-based differs from the above two in that the community typically owns and operates the mini-grid, although because of their constrained financial capacity, they often seek their funding from grants and concessions and subsidies from governmental sources, or public sources rather. And at the very small scale, the micro and pico solar scale, we see that there is a proliferation in solar home systems where customers simply put one or a few modules on their roof and they get access to basic electricity from these solar home systems. And these have been financed in 2 ways to date. Predominantly, there might be others, but this is the pay-as-you-go funding model and the fee-for-service model. Pay-as-you-go funding is typically also known as a lease-to-own model, where the developers sell the the equipment needed for the electricity generation to the customer. However, they finance it over a longer period so that it's more affordable for these households that don't have the upfront capital to afford the equipment. And instead, they pay a deposit, which can be, depending on the size of the project, could be $30, could be $60, and then they pay a monthly installment to the developer to pay off the equipment, and they get to enjoy the electricity from the project in the meantime until it's paid off, and then they own the equipment and they get to use the electricity from it. The fee-for-service model is different in that the developer doesn't sell the equipment to the customer. Instead, the customer pays a deposit to the developer, and the developer then sells electricity to the consumer as a service. So the consumer never owns the actual equipment in the end. Instead, they just buy the electricity. And let's have a look at a few of the developing environment case studies to date. First off, the Scaling Solar project, which is operated by the World Bank and the International Finance, the IFC, and this is a large-scale solar PV auction that has utilized DFI Finance, development finance institutions that have loaned money. It is the IFC that provided initial finance to get the project underway, and after that, other funding sources could be introduced once the risk has been brought down to a manageable level or an acceptable level for them. So the Scaling Solar basically provided a one-stop shop where they had the templates, the permitting, the site, all predefined and prearranged for the developers. And once all of that was sorted out and prearranged, developers were invited to bid for a solar PV project in that or on that site. And the result of that is that the price of the electricity coming from these projects was very competitive. We can see compared to the other African nations, the Scaling Solar in Senegal and Zambia are very cost competitive, and the time between procurement and financial close was relatively short, a lot shorter than in some of the other cases, because of this one-stop shop arrangement where finance was pre-arranged by the IFC, and all of the permitting, system design, and the documentation, the procurement process was predefined, prearranged, and this gave great certainty and reduced the cost at risk for developers. And we can see that leveraging the DFI finance in this case proved to be very successful. Another example of large-scale solar PV using auction procurement is the South African Renewable Energy Independent Power Producer Procurement Program, which sourced most of the finance from private sources. And here we can see that most of the debt was sourced on commercial terms from local commercial banks. South Africa was fortunate in that it had a well-established and deep capital market that could supply finance for these projects, and they didn't have to rely on concessional or grant funding to get these projects underway. And the interest rate that was charged was about 12% in local currency, which is seen as quite low and quite affordable, and is a testimony to the success of the program to date. The program also saw significant cost declines between the first bidding window and the last bidding window of 74%. We can see the results here. Costs went from 35 US cents per kilowatt hour in the first bidding window in 2012 down to 7 US cents per kilowatt hour under the fourth bidding window in 2015. So we can see the significant cost reductions throughout the project. Although the debt remained the same as the banks got more familiar with the projects, as it was seen as being less risky, and the environment was seen as more conducive and capable, the cost of the projects came down. The FIT Uganda is an example of utility scale solar PV projects that were procured using feed-in tariffs and feed-in premiums, and that used grant funding to leverage private and other sources of funding. So we can see here there was $100 million in original grant funding from development finance institutions, which was then used to get the projects underway and get the projects bankable, and saw further down the line public and private finance being unlocked to the value 4.5 times the size of the initial grant funding. So this has been successfully unlocking finance using grant funding, and using a feed-in premium that was paid by the development finance institutions, wherein 50% of the premiums were paid once the project reached commercial operation, and the remaining 50% paid against performance criteria as the electricity was delivered. So if they delivered less than, for example, 75% of the electricity that they stipulated in the power purchase agreement, they were penalized or didn't receive the feed-in premium. But as long as they were meeting their energy forecast and electricity forecast targets, they would receive this premium in addition to the feed-in tariff paid by the local utility. An example of a mini-grid case study using a hybrid utility private model is the Senegal ERSEN project. This is not the only mini-grid that was implemented through this project. They've done numerous. However, this is just one that provided insight into where the funding was sourced from, and we can see here that it was a 5 kilowatt solar project with a diesel backup. So it was a hybrid technology as well as a hybrid utility private operator model. And here there was grant funding from the GIZ for 80% of the project, with the balance coming from the customers and the project developer itself. And this project was permitted by the Senegal Rural Electrification Agency, which allowed the developer to lease the land, as before developers weren't allowed to send in electricity outside of the national utility. But here we can see that the project was successfully developed. The developer got his 12% internal rate of return, and the customers got electricity when they previously didn't have electricity before. So this is rural electrification using mini-grids under a utility private operator model. All right, and the last case study is examples of finance providers in the off-grid and the microfinance environment. We can see here there's examples of crowdfunding where investors at various scales, whether it be private household investors or institutional investors that give a variety of finance, these platforms allow developers to acquire finance from a variety of investors, and then the projects are then implemented and the investors receive their money back in the form of lease of the equipment to the customer or from the electricity sold on to the customer. The pay-as-you-go we discussed earlier, and these are some examples of companies that are operating in this field where they give finance to customers so that they can afford the project and get the benefit of the electricity without footing that initial upfront capital that would be unaffordable otherwise. And lastly, there are a few examples of the fee-for-service providers where the customer doesn't own the project in the end, but they do get the electricity that they previously didn't have at an affordable rate. So just to wrap up our final remarks, we can see that solar PV has seen continuous increase in capacity deployed and has seen rapidly decreasing costs to date. The mechanisms used have varied from feed-in tariffs and feed-in premiums to auctions and government programs, as well as mini grids and microgrids in the off-grid environment that have seen communities that were previously unelectrified having access to this clean form of energy. And the financing models and the innovations in the sectors, including the pay-as-you-go, crowdfunding, and fee-for-service, have meant that the upfront capital cost that would make these projects unaffordable in developing environments or in poorer environments, they can now access these technologies through these innovative finance models by paying them off over time and getting access to them where they otherwise would not have been. The role of governments is very important, as that they, in the end, determine how the electricity is procured and how it's deployed, and there needs to be collaboration between the regulatory bodies, finance providers, and developers to make sure that these projects are rolled out in a timely manner, and that the previously unelectrified or those that are in remote environments get access to electricity to improve their livelihood. And lastly, the innovative finance that we mentioned using minigrids or microgrids has allowed for developing environments to get access to solar PV without having to foot the high upfront costs themselves and pay them off in a longer term. Debt and equity are typically used, especially from private sources in most cases around the world, with debt being seen as the most cost-effective of the commercial finance instruments. Here are a list of our references that we used for this webinar. So you feel free to do some extra reading and follow up, have a look at these various sources. And thank you so much for listening. We hope you enjoyed it.